In this week's video, we're going to look at the recent decline in global excess liquidity and investigate some of the implications from that. So in the chart in front of us, we're looking at a measure of OECD excess liquidity, basically comparing money supply growth to nominal GDP growth. And over the past 12 to 18 months, we've seen two trends emerge. Obviously, a pickup in nominal GDP growth with the recovery around the globe, and in particular in the US. At the same time, we're seeing money supply measures begin to slow down. And so the end result is this measure of excess liquidity has slowed. So you'll also, I should say, around about 2% excess money over GDP after being in the 6 to 7% range for quite some time. What I've also done on the chart here is just created sort of regime periods where what is considered to be tight liquidity. So when excess liquidity has been less than 2%, and you can see some of the extreme levels that it has got to. So, and also, and they're actually shown there on the chart. Now, if we look at the relationship between the yield curve and excess liquidity, and you would expect there to be a relationship as policies tighten, excess liquidity will also be beginning to shrink, and policies being tightened because nominal GDP is rising. So we're showing the relationship between the two. This time the yield curve is the pink line, 10s minus 2s on the right-hand scale. So you can see the current curve down around about 20 basis points in the US, and that matches up pretty nicely with the downturn in global excess liquidity. What I've also done here this time is shaded in the periods of late cycle as measured by the difference between the unemployment rate and the estimate of NAIRU. Now, there's other methods to estimate the output gap, but this is purely just one. You can see, obviously, excess liquidity contracts in that very late stage cycle when policy is being tightened. So what has happened to some of the key market indicators and assets around these periods where excess liquidity is beginning to tighten up? So on this chart, we're looking at the US 10-year bond yield, and the shaded periods are periods of tight liquidity as we defined earlier on. So it would appear that they've generally been associated with some sort of topping out in the bond yield, certainly in the mid-90s. Early 2000s. Took some time for it to actually unfold during the 05, sort of 08 tightening and liquidity period. The Fed funds rate, which we'll see shortly, actually the Fed funds relative to neutral, so policies generally sort of been tight relative to neutral, although for a longer period during 2005 to 2008. If we now have a look at some of the market performances, and we'll just put those on a log scale. So this is the global equity market. So in the early 80s coincided with a decline, likewise a bit of a rolling over in the early 90s. Really didn't have much of an impact in the mid-90s. In fact, was the beginning of a very significant run up in market, so it wasn't a great indicator there. Was just occurred around about the time of the downturn in 2000, but market rose very strongly for some time despite what was considered to be tight liquidity conditions in 2005 to 2007. That's that excess liquidity measure we're talking about. Emerging markets, it's not very clear what was, whether it's a good indicator, because EM was actually performing quite well in the late 80s. There fell over in the mid-90s, likewise again in the early 2000s, but actually continued to run up. Eventually, the tightening of liquidity did cause a big, obviously a bigger downturn in 2007, 2008. So it would seem that, just a very quick look at some of the asset classes, that tightening in liquidity is a potential signal, certainly on a 12-month view of a potential peak in bond yields, and also a potential peak in equity markets. Thank you. There were two other items that we did want to bring up, and one was the performance of global banks relative to the MSCI. And we've been talking about the yield curve earlier on. So what we're tracking here is the G3 yield curve on the right-hand scale. So you can see the flattening over time. and the blue line is global banks in US dollars relative to the MSCI World Index. And so the steepening in the yield curve that took off, I guess, in the sort of the end of 2016, bit of excitement in the financial sector and bank sector in particular. It sort of held on to those gains, but the flattening of the yield curve, particularly driven out of the US over the past 3 or 6 months or so, has coincided with a renewed downturn in banks relative to global equity markets. So until such time as we see an upswing in the yield curve or a pickup in excess liquidity, it's hard to mount a strong case for banks to be outperforming. And then the other item we wanted to briefly touch on was just a bit of a quick take on the drivers of US equity returns. And so what we've done here in the top part of the chart, we've just looked at annual returns from the pink bars here represent EPS growth. The dark blue bars represent change in PE over the year. The light blue in there is the dividend yield, and then you can see very faintly the total return from US equity. So I guess has been talked about quite a bit already, but the PE contraction that we've seen over the past couple of quarters showing up on this chart, it's not unusual for that to occur, and to occur at the same time as strong EPS growth at this stage of the cycle. So it's very strong EPS growth, but PE contraction. If we go back to, and I should mention the line at the bottom of the chart on the right-hand scale is that unemployment versus NAIRU measure of the output gap. Now we can argue as whether how accurate the NAIRU is, but taking the current estimates, it suggests that the US economy is already in late cycle. If we go back to the previous point in time where that was the case, say 05 through to 07, you also saw a similarly period of strong EPS growth, up around 15-20%, but PE's in the contraction area. And likewise I suppose it took a little bit longer in the very latter part of the late cycle in 2000 through to 2001, you still saw strong EPS growth, but PE's beginning to contract. So this is something that you might typically expect at this stage of the cycle, strong EPS and PE contraction. What we've tended to find then when the cycle does turn, so it peaks and begins to roll over from a very strong level, you get both EPS negative growth EPS and also PE contraction, obviously leading to more significant downturns in equity markets. Thank you.